Welcome to Candlelight, where price is a mechanical function. This video is part 2 on how simple and easy it is, not easy, but how simple it is to catch powerful enough moves and strong enough moves where you can get moves that can give you 60% in 48 hours, and in this video, even more than that. And they happen all the time. You just need to be patient enough, and like I said in the last video, this video really ties in well into the last two-part videos where I explain how waiting really does pay off. If you choose strong enough zones, you will get ballistic movement away. Powerful zones give you strong moves. And if you couple that with multiple time frame analysis, which again, long word, but it's really simple. It's all it is choosing a larger time frame, a supply and demand zone, such as a daily, let's just say, and then you go down to your 60-minute chart, all the way down to your 5-minute chart, and as you do, your zones will become smaller and smaller and smaller. Every trade you take, you only risk 1% of your portfolio. You are risk averse. Like I said in the last video, you trade like a chicken. And if you do, if the zone is really tiny and you risk 1% and you catch a large move, you can very easily or very simply catch 20, 30, 40 up, even a lot more if you get strong zones. So in this video I want to show you just how regularly strong moves happen, and all you got to do is just wait for them. Let price develop. Let price tell you when and where you're going to get some strong zones. All right, let's jump right into it. So in the last video I said it was the Canadian dollar. I apologize. It's the Aussie dollar. But within the past 30 days we've had two fantastic moves. And the ones I'm going to be talking about is going to be in this leg right here and in this leg right here. So my left-hand chart, this is a daily where every candlestick represents 1 day's worth of price action. My center chart is a 240-minute, which is 4 hours. Every candle represents 4 hours. And the right-hand chart is a 60-minute chart. That's 1 hour. So let's jump right into it. Right here on the Aussie dollar, we are in an overall downtrend. So I want to be shorting, and I want to be shorting in supply zones. I want price to rally into a supply zone, and see, this was the origin of this drop here. And I want price to rally into supply because I want to sell high and buy low. And if I trade in a downtrend, I'm maximizing my profit potential because price should break the most current swing low and continue, really giving me those big home runners. Having said that, small 2, 3, 4 to 1 trades, fantastic. That's your bread and butter. But every once in a while, you can catch some significant home runs. And when you do, you want to let those runners run and then cash out as low as possible. In this case, we're shorting, so you want to cash out as low as possible. So when price is in supply, and in this case you had a rally base rally, that's a leg right there. And I know I said this a couple videos ago, but I'm definitely going to put out a video on describing what constitutes a leg. But it's a rally base rally on a daily. On a 240, this is the low. This is the rally base rally on a daily. But here you have a low, high, higher low, and higher high. That's an uptrend. So you have an uptrend coming into supply, and then that uptrend gets broken. Fantastic. Price is weak, but we still don't want to short yet. What we want is to short in a downtrend. So now you have a high, a low, and then when price comes back up, a lower high, and then a lower swing low that broke this. Now you're in a downtrend. So you don't want to short up here. While you're in supply, that's great, but price is still in an uptrend. You don't short uptrends, you short downtrends. So you wait for price to give you a downtrend, and then you short supply zones. So within this 240-minute supply zone right here, which is the origin of this swing leg, to the downside, that's where supply exists. So what you do is within that 240-minute supply zone, you look for a smaller time frame supply zone, which in this case is a 60, and this is the origin of this leg, and it's within this 240 zone. Fantastic. Once you get it, you wait for price to obviously fall away from that zone, and then you wait for price to come back into it. Once you do, you look for even smaller time frame supply zones. And in this case, you get one on a 5 minute. I'm just going to show you a 5 minute supply zone is right here. When price falls, giving you a 5 minute supply zone, and I'm about to show you what it looks like. Falls, when price re-enters that area, you're going to risk 4 ticks. 4 ticks on the Aussie dollar, because it trades to 1/10,000th of a penny, because this is currency. All markets have different tick values. On stocks, it's always going to be a penny. If you trade on bonds, it's going to be a fraction, and it depends what fraction, or depends what bond market it is. Sometimes the U.S. the 30-year bond goes up to a 1/32nd, and it sounds complicated, but it's really not. Just a tick value. Currencies, because they're currencies, they really do go down into fractions. But it goes by fives. So I can't 74,975 to 74,980, and then 8590. So it goes by fives. And so the size of this supply zone is 4 ticks. 77,160 to 77,180 divided by 5. That's 4 ticks. So it's a very small zone. But if you catch within a supply zone, you get a smaller supply zone. You have a really small area that you're risking that yields you a massive move. So before I go into how we're going to protect our profit, this is what, actually, I guess I should have made this, I should have kept this bigger. Hold on a second. All right, so within this 240-minute supply zone, you have your 60-minute supply zone right here. And then within the 60-minute supply zone, you have your 5-minute supply zone right here. And this is what it looks like. As price is rallying into your 60-minute supply zone, that's these 2 thick lines right here, this one, you're in an uptrend. You don't want to short uptrends, you want to short downtrends. So you want this uptrend to be broken, and it got broken right here. Within your 60-minute supply zone, you have a beautiful rally base drop. And let me make this a bit bigger. Rally base drop. You see ballistic movement out, and now it's on a 5-minute, but you're stacking the odds, and you're upping your odds enhancers by going into the center chart, large time frame to smaller time frame to smaller time frame, and you're just making that zone even smaller. So here you have rally base drop, a great supply zone. When price re-enters that zone, that's when you short, and this ties in fantastically into the last 2-part series where you have ballistic movement up into a zone, or ballistic movement is unsustainable. It goes into your zone. You short, you risk, or you put your stop loss, an order that'll take you out for a loss. Love your little losers. 1 tick above this zone. And since you're shorting, you're going to buy to cover 1 tick above. And if you're wrong, it just costs you 1%. And then price starts to fall. This is a fantastic short. This is not a beginner trade. This is a much more advanced level trade, but I just, for the sake of explanation, or for sake of explanation or teaching, this was a drop base drop. That supply zone is the one that broke this smaller 5-minute trend line. So you can also add to your position right here when price re-enters that area. And when it does, price falls. And it falls a great deal because you chose a fantastic zone. And all you do is risk 1% here, and this is what you do to protect profit. Price is now in a downtrend by what we saw over here, a high, low, lower high, lower low. So now you know it's in a downtrend, so it should break this next swing low, and it does. So when it does, when it's making it now it's really in a downtrend, it's really going, you put your stop loss, you bring it down to now in the green. You are now guaranteed to make money. You put your stop loss right where the line is, which is 1 tick above this swing high, because price should not be making higher swing highs in a downtrend. So if price does rally above this swing high, then you already got profit, you're good. But if price is in a downtrend, it should make lower lows. So this swing high, you bring your stop loss right here. And then if it continues to fall, you get another swing high. You move your stop loss. Actually, I can just do it right here, actually. you would bring your stop loss right there and expect price to continue to fall, and it does. And then you get another swing high right here, and it falls, so you bring your stop loss right here, and you're just protecting profit at this point. And then you get another swing high right here, and it falls, and you lock in profit here. And then you had another swing high and it falls, you lock in profit right there. This ties into another video I made, which is where supply and demand zones and trend lines really coincide. Right where price made a higher swing high, your downtrend is now over, and it also happens to be right where your trend line got broken too. And then you make profit. On that one, on a 4-tick zone, you caught 405 ticks. Because you sold at 77,160 and you bought back to cover at 75,135. You caught this whole leg. That's 101.25% in 3 days. Not bad. And the reason why you do know to cash out there is, like I said in the last 2-part series, anytime you have ballistic movement to the downside, right here, that's unsustainable. That doesn't last. So you want to be locking in profit as price falls and have your trend line there, because the second price does make a higher swing high and no longer respects your downtrend, you want to cash out as low as possible on that move. You want to catch the whole thing. Don't think it's going to go to the moon. Very rarely does it. But after catching 100% in 3 days, that's not bad. So that's just one move that happened. And then probably a week later, you're given this swing high. So right here, you could have shorted this zone, but it's really large. And you also want to get a lower swing low, right? You could have shorted here, but why? There's no point. You want price to, again, at this point now you wait. You don't do anything. You wait for price to rally and then give you another supply zone, which would be an origin of a strong move to the downside. And on a daily, here you go. And now made a lower swing low. Obviously respecting the downtrend because it's now making lower lows and lower highs. The origin of strong move to the downside, that's supply right here. So that's your daily supply zone. Within this daily, let's see if there's any areas that are even smaller. So within this daily right here on a 240, that's the origin of ballistic movement down. Right there, that's a 240-minute supply zone, and that's another one right here, ballistic movement down. So instead of risking all that, we now have 2 smaller ones. And this is what they look like on a 60. So within these 2 zones, we make them a bit smaller on a 60, which is right here and right here. And this dotted line is where within this 60, there is a small 5-minute supply zone. So you want to short these areas. So not only do you, so after you caught the initial move, you not only wait for price to rally, then fall again, giving you a supply zone, you then also have to wait for price to re-enter that area of supply. A lot of waiting, but it pays off. If you choose powerful zones, you get powerful moves. And if you made 100% in 3 days, you can afford to wait a couple weeks. Not bad. And in the meantime, you have other markets to be trading. This is just one market. So to fast forward on what you do, when price re-enters, as price is rallying into your zone, into your supply zone, I want to show you what this supply zone looks like, or what this one looks like on a 5 minutes. So within this 60-minute zone, this 5-minute zone, how did we get it? And I'm gonna fast forward through this, just so you don't see me scrolling everywhere. All right, on this 5-minute chart where every candlestick represents 5 minutes, the solid lines that you have here on a 60 are right here. That's your 60-minute zone. Within your 60-minute supply zone, you have a drop base ballistic movement out. That's where the imbalance of supply is. And the only thing that can make price move ballistically is a lot of supply. So within this 60, this is your 5-minute zone within it. So now we went from a large zone to a medium zone to a small zone. And per every single trade we make, we risk 1% of the portfolio. If the zone's really small and we catch a large move, that's much bigger profit, but that's a much bigger profit potential. So now I'm going to move the chart over to the entry of this zone on a 5-minute, and you'll see what it looks like. All right, and here we go. This rally on a 60, let me make this canvas a bit bigger because I'm used to having it small so I can see the whole thing. So as price is coming into supply, this rally right here from this low into here, that's ballistic movement, that's unsustainable. That's what it looks like on a 5-minute, right? So once price enters, you want to expect for price to break this downtrend or break this uptrending trend line and continue to the downside. And it does. And because your zone is so small, I didn't do the math on this one, but just by an example of how big the other one was, you can use your imagination on pretty close to the exact same percentage that you caught on this move. You, once again, because it's price in a downtrend, you short here. Here's your swing low, swing high, and it starts to fall again. You put your stop loss right here as it makes another swing. And as you're given other, swing lows and swing highs, you just place your stop loss right above the swing highs, and right where price is no longer making a lower swing high, right here it should have fallen from this point. It now makes a higher swing high. It coincides right with your trend line, break your trend line, and this swing high being broken. And then price reverses, but you already caught the low. So you sell high and buy to cover low. Those were 100% plus or close to 100% trades that you can catch in or that can be realized in about 2 or 3 days. You had 2 in a month on just one market. Just do the math on how many you can have if trading stock, for example, where you have hundreds or thousands of stocks you can be looking into and just waiting for good zones and not jumping in just whenever, but waiting for price to re-enter a good demand zone or a good supply zone. So I hope this was helpful. I'll see you guys in the next one. Take it easy.